Great, let's do the first class exercise on the conceptual framework. Charles Current, a second-year engineering student, operates a small electrical repair business from home. He's doing very well and is able to pay for his university fees from the cash generated from the business. His first financial year has just ended on 31 May 26. Now, guys, in any question, the financial year end date is of the utmost importance. And he attempted to prepare a statement of profit or loss and other comprehensive income and a statement of financial position, which he wishes to discuss with you. You meet him for a drink at the boss, and he gives you the financial statements that he has prepared. Then the conversation goes something like this, and they give you the conversation, and they ask from you, give your response to Charles's answers to your queries in the above dialogue. So all four of them, you see you and Charles, so they want you to comment on that. The dialogue has been numbered to assist you in your answer. For each query, you must indicate the following: whether you feel that Charles's response is valid or not, and then the B side, your reasons supported by the relevant concept or definition as per the conceptual framework, obviously, and the correct treatment for each item. Note, you may ignore the recognition criteria in your answer. Now, you may only ignore the recognition criteria if the question states that specifically. Otherwise, you have to discuss it. So let's go and have a look what the conversation looked like. Number one, I see that you've deducted your withdrawals of 8,500 Rand, see, from the business as an expense on your statement of profit or loss and other comprehensive income. Now, Charles says, yes, I work on my own, and that is my salary. If I had employed an assistant, his salary would have been shown as an expense. Can't argue with that one, can you? In addition, I'm concerned that my net profit might be high enough to attract income tax, and therefore I want to show the drawings as an expense on the statement of profit or loss and other comprehensive income. And now suddenly things doesn't seem to be all that kosher, does it? Because I must never ever pass any accounting entries with saving tax or avoiding tax. I'm allowed according to law to save tax by legal means, but I'm not allowed by law to avoid tax. There's a difference between the two. So in this case, he wanted to avoid tax. So his intention of showing that as an expense is not that noble. He has done that. His first argument sort of could have flied if it was not for the definition criteria. But the second argument actually put a big question mark behind his name. So let's see how you would have answered him. Now, clearly it is here about expenses. So we have to go and see what is the definition of an expense in order to answer him. The answer is no, he didn't treat it correctly. But why? The definition of an expense is a decrease in assets or increase in liabilities that results in a decrease in equity other than those relating to distributions to holders of equity claims. Now, before we go any further down with our explanation, let's see, was there a decrease in assets or increase in liabilities? Well, he took cash for himself. So obviously, his money in the bank has decreased with 8,500 Rand that he has withdrawn out of the entity. So yes, there was a decrease in assets. Did that result in a decrease in equity? Now, all of us know the accounting equation. Equity equals assets less liabilities. So if an asset decreases and the liability stays the same, what is happening to equity? Equity will decrease. And now the third criteria is that other than those relating to distributions to the holders of equity claims. Now, who are the holders of equity claims? That, guys, are the owners of any entity. If it's a company, it's the shareholders. If it's a one-man show, like in this case, it is Charles, who is the owner of the sole proprietorship. So he meets number 1 of the criteria. It meets number 2 of the criteria. But where it falls off the bus is in the third line of the definition criteria, because it is a distribution to the equity claim. So therefore, it can never be an expense. Now, over and above that is, let's say the salary Charles pays himself constitutes a withdrawal, as he is the owner, holder of equity claim, of the business. Therefore, the definition of an expense is not met. It is, however, correct that the salary he would have paid to the employee would have been an expense, as the employee would not have been an owner of the business. So if he paid a salary to the employee, there was a decrease in assets, there was a decrease in equity, and it wouldn't have been a distribution to the holder. So therefore, salaries meet the definition criteria of an expense. But remember, old Charles is not all that honest and all that noble, because he has some devious thoughts in mind. He wants to crook the receiver of revenue. Now, financial statements, now this is all about our characteristics of financial statements. So we say financial statements should be a faithful representation, which implies a neutral depiction as well as being free from error. Now, is it a faithful representation? No. Is it a neutral depiction? No, because Charles is biased, because the reason why he posted it in the income statement is so that he's going to have less profit and therefore pays less income tax. So therefore, his financial statements won't be a neutral depiction of the phenomenon, and not if it is actually include that as an expense. Also, financial statements should be free from error. Now, obviously this is an error, so if he's going to recognize it as an expense, there will be an error in the financial statements, so that means that it also will not meet that qualitative characteristic of financial statements. So, the correct treatment would be to include withdrawals in the statement of financial position as a decrease in owner's equity. Don't have to talk about recognition criteria. I can stop just here. Right, the second question that I said is, you ask him, there's a revenue item of 12,000 Rand and it's revenue, right? Income. In the statement of profit or loss and other comprehensive income, described as cash received for contract work. What is it all about? Charles, I do work for the rugby union, maintaining the lights at the stadium. They paid me 12,000 Rand at the beginning of the season to maintain the lights for the period 1 March 26 to 31 August 26. Guys, what is our financial year end? Our financial year end is 31 May 26. Somewhere in between, in this period of time, from the 1st of March to the 31st of August. So, now this contract just came in time to boost my profit for the year. What is the underlying principles on which financial statements are based on? There are two of them. One of them, underlying assumptions. The first one is the going concern concept. It's got absolutely nothing to do with this point here. The second one is the accrual basis of accounting. Now, what is the accrual basis of accounting states? The accrual basis of accounting states very specifically that income is recognized when it is earned, not when cash flow took place, when it is earned. So the question is now, have I earned the full 12,000 Rand? And the answer obviously is no, because I've only earned from 1 March to 31 May. The remaining 3 of the 6 months I haven't earned as yet, because I still have to perform the work in the next financial year. And I only earn that income after I've done the work. So therefore, I cannot recognize a full amount of 12,000 Rand as revenue. So what is revenue? Revenue equals income. So obviously I have to talk about income. And that portion that I'm not allowed to recognize now, remember what happened when I received the money? I debited bank and I credited service fee income, 12,000 Rand. Now it's year end, I have an income item of 12,000 Rand. I realize it's not correct because I've only done half of the work. So 6,000 of the half of the 12,000, I am not allowed to recognize now because it is from the 1st of June to the end of August. I'm only allowed to recognize it then. So obviously I'm going to debit my income account with 6,000 Rand and I'm going to credit another account, income received in advance. Now that income received in advance is a liability account. So it's a credit balance, credit balance liability. So let's see how we're going to handle and answer this question. So in the first place, we say, no, I do not agree. We say that the amount received is either income or it is a liability, or in this case, basically a combination of the two. So let's start with the liability story. We say that the definition of a liability, it is a present obligation of the entity to transfer an economic resource as a result of past events. And then we must talk about this present obligation story. Present obligation of entity is an obligation, is a duty or responsibility that the entity has no practical ability to avoid. That is very important words. Can they get out of this? And there was a contract that they actually entered into with the rugby union, and they have to perform under the contract. Now, if they don't perform under the contract, what is going to happen? They will have to pay back the money. And the second portion is to transfer an economic resource. Now, what is an economic resource? Now, that is that there's a possibility of paying a payment of cash in the future should Charles not fulfill the contractual commitments. So the economic resource that we're going to transfer is he's going to use whatever he needs to. He's going to use his labor, he's going to use certain materials, and he is going to maintain the stadium. So obviously, there is going to be a transfer of economic resource in the next 3 months of the contract. Good. If he's not going to do that, he has to pay back the rugby union. So again, there would be a transfer of economic resource because he needs to pay them their money back. So we say that seeing that the year end is 31 May and the 12,000 Rand is for the period 1 March to 31 August, 3 months included in the 12,000 Rand that does not relate to the current financial year, so 6,000 Rand. And I want you to add here, according to the accrual principle, income is recognized when it is earned. And in this case, income has not been earned as yet. Why not? Because they haven't performed the work as such. Okay. Now, current, there's 2 words there. Oh, please. Charles has a present obligation to either fulfill his duty of maintaining the lights or repaying the rugby union if he does not deliver the service. The transfer, the past event, is the signing of the contract that legally binds him. If he does not render the service, he would have to pay back the 6,000 Rand, which embodies the outflow of economic resources. If he does render the service in the next financial year, economic resources in the form of his time, his tools, new lights, labor, etc. will flow from his business. Seeing that he has not yet rendered the service for the last 3 months at year end, at this point in time, the amount constitutes a liability. Okay, because it actually meets all the requirements of a liability. Now, what about the income that I am allowed to recognize? Now we say that the definition of income is an increase in assets or decrease in liabilities that result in an increase in equity other than those relating to contributions from the holders of equity claims. Now, was there an increase in an asset? Yes, there was. They paid us 12,000 Rand. So we received 12,000 Rand in advance. So the 6,000, we said it was in advance for the next 3 months, but 6,000 was for the current financial period that I have performed my job already. So there was an increase in assets. Or was there a decrease in liabilities? No, there was an increase in assets. That resulted in an increase in equity. We know the accounting equation. Equity equals assets less liabilities. If liabilities stay the same and assets has increased, what has happened to equity? It has also increased. So it also meets that one and that one. Was it a contribution from the holder of the equity claim? Did we receive that money from the equity holder, the owner of the company? No, we received it from the rugby union. So it meets that one, and it meets that criteria. So in the current financial year, economic benefits increased with 6,000 Rand in the form of cash received. The service was rendered during the accounting period and assets increased in the form of cash received. The cash was not received from the owner and therefore the 6,000 Rand for the first half of the contract. Let's put that in a different color. Constitutes an income. What is our conclusion? Our conclusion is that the 6,000 Rand for the first half of the contract should be recognized as income in the statement of profit or loss, and the 6,000 Rand for the last half of the contract should be recognized as a liability in the statement of financial position. Right. Number 3. Last time I was at your house, you showed me a computer that you bought for your business. I don't see the computer on the statement of financial position. Charles replied and said, I bought the computer on one of those installment sale or hire purchase agreements. On reading the small print, I saw that ownership of the computer will not pass to me until the final installment is paid, which will only be next year sometime. Now remember when we did the conceptual framework, we did this whole concept of substance over form. The economic substance of any transaction is actually is the preferent one. We're going to use that over the legal form of the transaction. So if we go now to the answer to that one, we say, well, that's also not correct because we are going, what can the computer be? It can only be an asset. All right, so let's have a look at the definition of an asset. An asset is a present economic resource controlled by the entity as a result of past events. So what is economic resource? It is a present right that has the potential to produce economic benefits. Now, let's apply to the computer. Is there a present right? That one there. Is there a present right that has the potential to produce economic benefits? Well, there is a present right. Charles has the present right to use the computer. He's entitled to all the income that the computer is going to generate for him and all the benefits associated by using the computer. Does this right of his has the potential to produce economic benefits? Well, for this potential to exist, he does not need to be certain that the right will produce economic benefits, but obviously he's going to use this computer for business purposes, so he's going to generate invoices for work that he has done with that computer. He's going to send out account statements from that computer. He is going to keep track of work that is done or has to be done on that computer. So obviously, there are economic benefits that will flow to the business as a result of using the computer. Right, was there controlled? Is there control? Does Charles control the computer? Now, we say here that it is all about substance over form. The computer is a resource and it is used in Charles's business. Charles controls the computer because he can decide how much, when, where, and how much he's going to use it. Now, he doesn't have to own the computer in order to control the computer. So he will decide what is happening to the computer. What is going to happen if something happens to the computer? The computer is going to fall down and it's going to break in 5,000 pieces. Does Charles still have to, whose risk is it? Let me ask you that way. Whose risk is it to repair the computer? It's Charles's risk. The bank doesn't give cahoots anything about your falling down of your computer. He doesn't want to know about that. All he wants to know is that you're going to pay that computer initially. So basically, all the risks and reward of ownership of that computer has already been transferred to Charles. And therefore, Charles controls the computer. Therefore, the substance, the economic substance of the transaction is such that we can recognize that as an asset in our books, because Charles is the person who controls the use of the computer. Now, the last thing is as a result of past events. Now, what was the past event? Past event was the date that he purchased the computer and he received the finance for that computer from the bank. So that is the date when the risk and rewards of ownership has passed to him. Risk and rewards of ownership. Right. So what is the conclusion? The conclusion is the computer should therefore be recognized as an asset in the statement of financial position. Remember that the corresponding credit entry would have been a liability because that is the finance that he received from the bank. He would have debited the asset, which is the value of the computer. He would have credited the bank with a loan that he received from that specific bank. So if they ask you to talk about the loan, but that is not the issue on hand here, but if they did ask you to talk about the loan, you would have then see whether that loan has met the definition criteria of a liability. Great, and then the last one. I see a relatively large item of 3,000 Rand on the statement of profit or loss and other comprehensive income for electrical cables and globes. It looks like you rewired most of the rugby stadium. Charles, oh no, not at all. I bought these cables and globes for 3,500 Rand in August 24, somewhere in the financial year. And I still have approximately 2,000 Rand of those cables and globes at home. So guys, what happened when he bought the cables and globes? He credited his bank account with the amount he paid for it, 3,500, and he debited an inventory account for cables and globes of 3,500 Rand. Now, as he has used those cables and globes, he has withdrew that value of the globes and the cables that he's used out of the inventory account. So he credited the inventory account and he debited an expense account to what value? To the value of 1,500 Rand, the difference between the two. So obviously, he doesn't have an asset of 3,500 Rand anymore. He only has an asset to the value of 2,000 Rand, which is the cables and globes that he hasn't used as yet. And he has an expense item for that items that he did use in the current financial period of 1,500. So we are going to talk about assets and we are going to talk about expenses. Right. I'm not happy with the way that he presented that in these statements. So we say that there are two main issues. The first is what amount should be recognized in the income statement, if any, and secondly, whether the item represents an expense or asset or a combination of two. Now, as soon as it is an asset, obviously, it is in the statement of financial position. Or is it a combination of the statement expenses, statement of profit or loss? Good. Now let's talk about the 2,000 Rand closing balance of cables and globes and we see whether that meets the definition of an asset. An asset is a present economic resource, that's the first part. Second part, controlled by the entity. And the third part, as a result of past events. So let's have a look what is a present economic resource. That is the right that has the potential to produce economic benefits. Now let's apply that to the inventory on hand. Is there a present right? Charles has a present right. He can use that cables and globes as and when and whatever in how many he wants at whatever period of time that he decides on. So he has the right to use the cable to maintain the stadium and to pocket all future income and benefits associated to that. Is there potential to produce economic benefits? Yes, of course, because by using those assets, he is going to invoice the client who is going to use the asset and he's going to earn some money out of it. So he's going to produce economic benefits. So when he provides the service, it will also give him then income. Is this 2,000 Rand inventory item controlled by the entity? Yes, Charles controls it because he decides how much, when, where, what, and how many cables can be used. And then the last one there, controlled by the entity, we've done as a result of past events. What was the past event? Past event was when he purchased that, the delivery date of the cables and the globes. Now, we've already said to each other that the 3,500 Rand purchase price was used to record the initial transaction. So, nowhere in the books, the 3,500 Rand will appear as an outstanding balance. 2,000 Rand, we said, we're going to recognize as an asset, inventory item. And then 1,500 Rand, 3,500 initially paid, less the 2,000 Rand still on hand, so 1,500 Rand is going to be expensed. Now, what is the definition of an expense? There is a decrease in assets or increase in liabilities that result in a decrease in equity other than those relating to distributions to holders of equity claims. So let's just quickly check. Was there a decrease in assets? Yes, there was. We had inventory assets of 3,500 Rand. We are only having 2,000 Rand of those globes left. So obviously we've used 1,500 Rand. So there was definitely a decrease in assets. Did it result in a decrease in equity? Well, guys, if nothing happened to liabilities and our equation equals equity equals assets less liabilities, assets decreased, liabilities stayed the same. So what happened to equity? Equity also decreased. Was it a distribution to a holder of the entity? So if it's a sole proprietor like Charles, was there any withdrawals? The answer is no. This is definitely not a withdrawal. It was something that was paid to an outside party when he purchased that globes. So the cables and globes are therefore the economic resources in the form of assets or inventory decreases. The cables and globes were used during the accounting period. The corresponding income for this expense would also have been recognized in the same period. Right, matching concept. Assets in the form of inventory decreases flowed from the business and it was not a distribution or withdrawal from Charles. So what is our conclusion? The 2,000 Rand globes and cables on hand should be recognized as an asset in the statement of financial position, and the 1,500 Rand used should be then recognized as an expense in the statement of profit or loss and other comprehensive income. And that concludes then this question of Charles Current.